The average salary in South Africa has weakened amid the underperforming economy, high unemployment rate and soaring inflation, and of course the lasting impact of the COVID-19 pandemic. That's according to the BankservAfrica's 5-year review of take-home pay and private pensions in South Africa between February 2018 and February this year. BankServ also says the number of salaries paid into the bank accounts of South Africans is an early indicator of the state of the employment market. Judging by the quarterly labor force survey released yesterday for the first quarter at 32.9%, the picture in terms of incomes in the country does not look good. Why does this matter? Well, we joined by Elize Kruger, an independent economist who also works on the BankservAfrica Take-Home Pay Index. Elize, thank you very much for your time. Elize, we saw yesterday the unemployment numbers really rising, 0.2% in terms of the first 3 months of 2023. But I want us to start by talking about the average nominal salary. When we talk about that, what exactly are we talking about?
Lani, yes, the average take-home pay index that we calculate for BankservAfrica is the number that, or the average that's been calculated by taking the total value of all salaries paid into the bank accounts of South Africans divided by the number of salaries. So it's an average of take-home pay in the South African economy for the salary payments that goes through BankservAfrica as a clearinghouse. So that is a sample of about 25% of the total employed people in South Africa. So a fairly comprehensive sample, I would say. And, you know, we calculate that every month, and then the purpose of this special report was to look at the trend over 5 years in this take-home pay or net salary. So after all deductions, you know, what you physically have in your pocket that's paid into your bank account.
Elize, according to this take-home pay index, over the past 5 years, salary, the nominal average salary has increased from 12,573 rands in February 2018 to 15,438 rand this year in February. That is a 22.8% growth according to BankServ. That growth is good. How do we compare to other emerging economies when you look at average nominal pay?
So we haven't actually looked at other emerging economies in the same, you know, in a comparison to our peers. But what we did look at, and that's, I think, is quite important in terms of the purchasing power of that salary, is what happened to inflation over that same time period. So the inflation rate, you know, if you calculate it exactly on the same time frame, increased by 26.6%. So that clearly shows that the nominal take-home pay did not keep up with the trend in inflation, and as such, now households and salary earners have been experiencing an erosion of their purchasing power over this 5-year period. And if one then, you know, really look at what happened to the economy in this time period, it doesn't surprise you, because we actually had an average of 0.5% economic growth in this period, you know, if you look at it per annum. So it's been a difficult economic environment, and not conducive to, you know, to comfortable salary increases or significant job creation for that matter.
Looking at the past 5 years, since 2018, salaries did keep a pace with inflation until 2022. What happened last year that turned the tide? We've been doing coverage of the rising cost of living in the past year, and particularly in the past 18 months. But what specifically happened during 2022 that has eroded the purchasing power when it comes to these salaries?
Yes, indeed. So the first 4 years of the 5, you know, take-home pay did keep up with inflation. But then you'll recall that early last year in Feb, we had the Russia-Ukraine conflict that started with a significant negative impact on commodity prices and many other products, you know, linked to those countries, but also linked to the supply chain dynamics. And we saw actually not only in South Africa but globally that inflation shot through the roof. So we had an average of 6.9%, quite significantly above our previous few years. The first 4 years of this time period, we had an average inflation rate of 4.1%, and then it shot up to 6.9%. So that's a steep increase in prices in combination with quite a dire economic environment, that played out, specifically load shedding, higher interest rates that followed on the high inflation numbers. When they all added up, we still have the high unemployment numbers. So the whole environment is just particularly negative from 2022, and it's now moving into 2023, where we are seeing almost more of the same in terms of those pressures that have kept a lid on salary increases.
What is interesting is that as you're talking about what happened last year, the index also shows that companies that had previously said that there is going to be potential expansion, meaning they will be hiring more people, because of all those issues, load shedding, rampant high production costs due to fuel prices and weaker currency. There is a shift now when it comes to their expansion. It's all about self-sufficiency for companies, which means this is bad news for the jobs and the labor market going forward.
Absolutely, Kulani. Companies are typically now in what we almost want to call survival mode, needing to redirect capital from expansion just to mitigate load shedding and to keep doors open and to keep the business going. So unfortunately, that is a negative in the sense that, that's a capital that could have been employed, to grow the business, to appoint more people, are now redirected, towards self-sufficiency and towards just, keeping doors open, surviving in this difficult economic environment.
Interesting as well is that you have observed that I think it's in the past 5 years that the number of salaries paid has only increased by 455,000 new salaries. Or is that over the past 5 years? Because when it comes to population growth, when it comes to economic growth, we know they're out of kilter, but this number seems very low for a five-year period.
Yes, indeed. It is quite low, and it's almost a symptom of, the economic environment that I just talked to. But what I just wanted to alert is that you remember this is 25% of the total employment, people employed. So it's a snapshot. It's not the total picture. But for this sample that BankservAfrica has access to, that was the job creation that we saw over the 5-year period. But, looking at yesterday's numbers, and I think we had an increase of 288,000 or so in the numbers that Stats SA reported on, which is a bit of a bigger picture given that they look at the total economy.
There is some good news when you also look at what BankServ has found when it comes to the private pensions. There is some improvement on that front in terms of comparison to inflation. Tell us more about that.
Yes, indeed. That is an interesting observation that we found in the BankServ data, is that the average pension payout has actually increased not only in nominal terms but also in real terms. So it has indeed outperformed inflation. So over this 5-year period, the average pension payout increased by 43.6% compared to that 26.6% inflation comparison. So that was quite interesting, and also, a bit of positive news that pensioners out there should keep, or their purchasing power is likely to keep up better compared to salary earners.
And of course, the outlook does not look actually promising. It looks bleak because of those unemployment levels and the load shedding situation, which with stage 6 expected to be with us for some time. It doesn't bode well for the economy. Surely when it comes to the fears of a possible recession, this keeps those fears quite elevated and the possibility high.
Absolutely. If we look at economic growth this year, if we look at the current scenario on load shedding, but also all the other factors that have contributed to this difficult environment, the high cost of living, high interest rates, all of that in combination, I would say will result in a very similar play out in 2023 and most probably in the medium term. So we are saying, expect more of the same in terms of take-home pay, likely not to keep up with inflation in the short to medium term, especially as long as, levels remain elevated, as we currently see with our headline numbers still at 7.1, and, food inflation still about 14%. Levels on inflation is still quite high, so that erosion of purchasing power is likely to continue for some time.
Elize Kruger is an independent economist. Thank you very much for your time. Not some good news at all when you look at the average salaries in South Africa over the past 5 years. BankservAfrica finding out that our salaries, our money is not is losing purchasing power basically.